everybody, Strongman here. Hello. Welcome back to Strongman Personal Finance. We got a sponsored video today. That's right. Somebody paid me $50 to look over the financial statements of a stonk. And if you want a sponsored video, it doesn't have to be about stonks. It can be about anything. I can react to stuff, whatever you want me to do. See the pinned comment below at the conclusion of this live stream. I don't do stock price predictions. I don't do valuations, but I'll react to any videos you want me to do. Come on. So in this video, in the sponsored video, we're going to talk about Atlassian. Now, I didn't know this company existed, but I did recognize one of the products, and we'll see that in a second. So what is that? Okay, we sharing. I'm always paranoid we're not sharing. Anyway, Atlassian Corporation, through its subsidiaries, designs, develops, licenses, and maintains software. It's another software company. Let me guess. Lots of stock-based compensation. Its product portfolio includes Jira, a project management system that connects technical and business teams. So I pulled up Jira, okay? And I guess it's out in, I need Jira to help, bring my team together and track projects. I saw that NASA was using Jira. I don't like NASA. I think NASA's a bunch of clowns, so I am not happy with this stock already, okay? And apparently they think NASA is a Fortune 500 company. Is NASA a Fortune 500 company? I think not. Imagine if it was. That'd be insane. NASA's publicly traded. Confluence, a connected workspace that empowers organizations to create, organize, and share information. So instead of sending emails, you can use Confluence, okay? And then they have Loom. This is one of their many products and softwares that they have. Loom. It's a way you can record videos. Oh, wait a minute. Here we go. Easily record and share AI-powered video messages with your teammate. Yeah, so instead of walking across the office or just sending a Teams message, I'm going to send you an AI-powered video message. Yeah, that makes freaking sense. Who uses this crap? Okay. Just get Microsoft. Who needs this freaking garbage? Anyway, so it's a software company that provides a bunch of different products for the workspace, basically, for corporations and stuff. Okay, so how's the stonk price done? Now, the genius is, okay, if you're a genius, basically, you pull up a stock and it's bad stock. It's bad. Look at the past performance, bro. Okay, it went up in a vertical line and then it crashed. So I guess the stock was probably doing fantastic. The company's doing fantastic during the clown market, and the stock has since plummeted from PLUTO back to terra firma. So we got a market cap of $42 billion, so it's not a small company. Revenue of $4 billion. So they got a price to sales of 10, bro. Negative net income. Let me guess, stock-based compensation. And a forward PE of 51. Are they going to become profitable? Oh, no. Well, their earnings are on October 31st, 2024. Let's go look at their old financials. So revenue's going up. Every software company looks like this. 45-degree angle, base 30 degrees. It's all about the degrees, okay? It's all about the angles. This is like a 30-degree angle. Other revenue all over the place. Total revenue going up at, I'd say, a good 35. Gross profit margin, very high profit margin software. Operating margin, negative. Mostly probably stock-based compensation. And insanely high free cash flow margin. Shocker. Every tech company does the same thing. They give out shares like candy, okay? But maybe this is an AI company like Palantir. So recently they've had a pretty decent increase in operating cash flow. Let's see, capital expenditures. They don't really spend a lot in capital expenditures. I mean, their operating cash flow for the last quarter was $426 million. And they only spent $13 million in capital expenditures. Acquisitions. Whoa. They did a big acquisition a couple, 9, 10, 11 months ago. Okay. So they acquired a business. Do they sell anything? Nothing significant. Let's see. How do they? Oh, they just packed on a bunch of long-term debt. That's interesting. So they made the acquisition a couple quarters ago, and they just packed on a bunch of long-term debt. What are they doing with that? What are they doing with their long-term debt, ladies and gentlemen? Well, they bought back stock. They bought back some stock, but not enough to cover the long-term debt. Why do they take out long-term debt? I need to know. Okay. But basically, this is a free cash flow machine. But it's unprofitable on the accrual basis of accounting because when the companies give out stock-based compensation, how it works is they use a model. I think it's called the Black-Scholes model. And they say, this is how much the share compensation costs. This is the notional value. And they expense the cost of the stock-based compensation over the vesting period. So they're spreading out that cost, and then it vests. And then when it vests, the employee can decide or elect to exercise the stock option. Basically, the employee gives the company cash. The company gives the employee stonk. Okay? And then what the company usually does is it spends free cash flow to buy back the shares that were issued to compensate the employee. So the true cost of stock-based compensation is the amount of money the company is spending on buybacks to stop shares from exploding. Okay? That's what they're doing. That's how that works. Okay? But overall, I mean, this is another software. I mean, like obviously it's got a very high price to sales, very high price to books, price to free cash flow, not crazy high. I mean, it's a software company. It's a highly profitable on a cash basis software company. Okay, let's go to the most recent earnings.
Atlassian, come to my country, Atlassian, before it sinks in the ocean.
Yes, I know that's not Atlantis. Shut up. All right, so this is their fourth quarter fiscal year 2024 results. Revenue up 20%. Subscription revenue up 34%. Quarterly GAAP operating margin of negative 6%. And non-GAAP worthless garbage operating margin of 20%. Quarterly cash flow from operations of $426 million. And free cash flow of $413 million. Basically, they don't spend a lot on capital expenditures. Okay? This past year, we once again proved to ourselves that we can accomplish big things. I'll show you something big. We grew revenue to $4.4 billion and generated free cash flow of $1.4 billion. I mean, they print cash. Okay. We announced transformative innovations for our customers like Rovo, the latest human AI technology, reshaping the way we work. We achieved significant milestones like FedRAMP's in process status, a huge step towards supporting the U.S. public sector in the cloud. And we wound down support for server. Okay. So amazing. When I look back on the last 23 years, I am filled with pride at what two mates from Australia, they're mates, okay? They did a good job. Okay, so let's go look at the financial statements. Oh, what is their do they give guidance?
Did they give guidance, bro? Where's the guidance? See if we can find guidance. Or 2025, bro.
Okay, so financial targets. Atlassian is providing its financial targets as follows. First quarter fiscal year 2025. Total revenue is expected to be in the range of 1149 to 1157. So they're projecting 1.14 to 1.15 billion of revenue, which if we go back to the prior quarter, what are they projecting their revenue growth to be? It's a pretty significant growth. So their Q1 2024 was 930 million, and now they're guiding for, let's say, worst case. What was it, 930? 23% revenue growth is the guide. Cloud revenue growth year over expected to be 27%. Data center expected to be 35%. I mean, so they're still projecting pretty solid revenue growth. The full year revenue growth is expected to be approximately 16%. Uh-oh, is that a slowdown? So the last year between 2024 and 2023, their revenue grew 23%. And now they're guiding for 16%. So that's probably why, I don't know, did the stock sell off after earnings? Was this the earnings date?
Oh my God, the stock dropped.
Maybe their guide wasn't impressive to Clown Street, okay? The accounting washouts. Let's see. Okay, so revenue growth is decelerating, but that could change. Who knows? Okay, it's a guess at the end of the day. Okay. Let's look at the income statement. So we know subscription revenue is up massively. Other revenue was down, and maintenance revenue is flat. Did they divest? Highly profitable in the gross profit. So, okay. So a lot of the stock-based compensation is built into these numbers here. So if you're looking at research and development and you're thinking that they're spending $589 million on R&D, that's not necessarily true. Part of that is the stock-based compensation for the employees that are working in research and development. Okay. So those numbers are baked in there, and those are non-cash expenses. That's why, because they're expensing it over the vesting. There actually is no cash expense because the company, when they issue the shares, the employee pays the company cash. The only cash expense is when the company buys back the stock in the future to mitigate dilution. So that's what you kind of have to guess, how much they're going to spend. How much of your future free cash flow is going to be eaten up by buybacks for stock-based compensation? Oh, good luck guessing that. Okay, so a lot of these expenses are stock-based compensation. As a matter of fact, let's see. Oh, and there's even some built in the cost of revenue too. So it looks like how much stock-based compensation is built in. Let's see, 17 plus 183 plus 33 plus 38. So 271 million out of this right here, out of 981 is stock-based compensation. So roughly 27% of this expense is stock-based compensation. Okay. Now you can clearly see if there was no stock-based compensation, it'd be a profit. But according to the rules of accounting, you have to expense it, okay? Because it technically is an expense. In the future, you're going to have less free cash flow per share that can be given to you because it's going to be used to buy back shares for employees. Okay, they have a lot of interest income. I mean, obviously, they probably have a bunch of cash. And they have provision for income taxes. Why do they have a massive income tax expense? I wonder if they did an adjustment to something on the balance sheet. So a huge part of the loss was because of probably some kind of tax adjustment. Okay, but that's like probably a one-off. They could have. We'll see what they did. We'll look on the balance sheet. Okay, so the earnings per share dropped massively, but basically that's because of this tax adjustment, which is not going to be continuing forever. Shares outstanding, 260. So shares are up 1.1. So not crazy dilution. Okay.
Let's look at the balance sheet.
They got $2.1 billion of cash, 161 of marketable securities, and 628 of accounts receivable. So their total highly liquid assets are $2.9 billion. Their current debts are $2.6 billion, of which $1.8 is deferred revenue. That's cash they've received up front, but they haven't provided the service yet. So this company's short-term assets to short-term liabilities is very strong. Even if all the customers canceled and got refunds, they'd still be fine, okay? So short-term assets to short-term debts, nothing crazy there. Long-term assets, let's see, very capital asset light. I mean, yeah, leases, okay. Strategic investments, what's that? That went down a little bit, probably all unprofitable. Intangible assets. So intangible assets are assets that you can't touch, patents, trademarks, etc., that are expensed over their life. So they pay the cash for it up front, but that cash doesn't hit the profit and loss. The cash gets expensed over the useful life of the patent or trademark, etc., etc. So it goes on the balance sheet, and over time, that hits the income statement. That's what happens. And a lot of fraud, people put stuff on the balance sheet to hide it away. I'm not saying it's fraud, but you can hide expenses in assets. Goodwill. So they did a huge acquisition. Okay, we saw that. Goodwill is up significantly. Goodwill is paying more than the fair value of a company's net assets. If you wanted to buy strongman personal finance, like me, the human, okay, you wanted to buy me. My fair value is $100. I am worth $100. Okay. If you just, took my flesh and organs and harvested them and sold them, that's how much I'm worth. But I also have a job. So I have future income streams that I can produce as a living, breathing human. So I'm worth more than the fair value of my organs and my schlong. Okay. Think about that as goodwill. Hope that's a good comparison. All right, so deferred tax assets went down. So a deferred tax asset is you're saying that you're going to save taxes in the future. You think you're going to save taxes in the future based on differences between your tax deductions and your GAAP deductions. Because expenses you see on here may not be deductible on taxes, or they may be deductible at different times. So that creates deferred tax assets and deferred tax liabilities. It went down, so I suspect part of this could be the reason why we had this huge tax hit, this huge hit for provision of income taxes there. But I don't think that's all of it. Let's see. And deferred tax liabilities went up. So that could be potentially part of the reason why they took that huge hit for taxes. Let's see. But it was probably like a non-cash thing. It's basically saying we think we're going to pay these taxes, or we think we're going to get this tax benefit in the future. But if tax law changes, maybe they're not going to get it, so they have to adjust it. All right, so long-term debt. Let's see. Okay, I guess they didn't really pack on a lot of long-term debt. Basically, a big chunk of their increase in debt is deferred revenue, which is cash they've received up front that they're not going to earn until at least a year after the date of this end of balance sheet. Lots of stock issuance. Okay, look at this additional paid-in capital. Up massively. Massively. Okay? That's why the stock-based compensation expense is so high. They're giving out a bunch of shares for employees. And once they vest, those employees can exercise those. And you as a current owner gets diluted. Okay, here's a statement of cash flows. So $273 million of stock-based compensation expense. We know that's the largest non-cash expense. What else happened here? Let's see. Net loss on strategic investments. Okay, they took whatever they're invested in probably isn't profitable. So tiny loss. Nothing crazy. Okay. But the biggest thing to note is stock-based compensation. All right, that's for operating activities. But their free cash flow went up pretty significantly. Or their operating cash flow. Now, a big reason of that could be a timing with accrued expenses. So basically, they expensed a bunch of short-term expenses that they haven't paid in cash yet. So accrued expenses went up, which is why they added it back on the statement of cash flows. All right. But I mean, like, they have positive, they're fine. Okay. They don't have trouble with generating cash flow. All right. Business combinations, purchase of PP&E, marketable securities. Okay. Nothing really crazy when it comes to investing activities. Cash flows from financing activities, repayment of term loan. And okay, so they issued debt to pay off some other debt. It's basically what they did. They rolled over some debt. And then they spent about almost $200 million buying back stock. That's the cost of stock-based compensation. This is the cost of stock-based compensation. They're buying back stock to mitigate dilution. Okay. So, I mean, this thing ain't going to go bankrupt. It ain't the worst unless there's like fraud in the near term. This isn't the worst thing in the world, but just know that it's like a typical tech company. I mean, what do you know about these? What do you know about Jira? What do you know about Confluence? What do you know about its market share? What do you know about its competitors? How are they doing versus their competitors? Why is their revenue growth massively decelerating for the full year? I mean, that's stuff you got to look into. But that's the financial statements. I don't see anything crazy. Just a lot of stock-based compensation, like any other freaking tech company. Okay. All right, let's do some comments. All right, so that was a sponsored video. See the pinned comment below if you want a sponsored video. I made a call for the Vixie. Hi, Strongman. I am a software developer. Just about every software dev uses Atlassian for project management. Well, that's interesting. Okay, that's interesting. Man, Strongman is doing 2 streams in one night. Nice. Yeah, well, after this, I'm going to get wasted, bro. Should I unfollow Lufufu? Yes. Can you help me 10x? If you send me $20 million, I'll help you 10x. NASA is the home of the best. Of course. Thank you, Khmer. SBC is finance. That's why they're auditor flagging this. Joseph Carl, don't even get me started on that clown. All right, so if you want to sponsor video, see the pinned comment below. Buy my book, Stop Being a Broke Loser, and you guys have a wonderful night. Cheers!